This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a weaker open with markets on edge awaiting Israel's response to Iran's missile strike. The US payrolls report later are set to give fresh signals on the Fed's next move. Crude prices surge as President Biden feels uncertainty over the Middle East conflict, saying an Israeli attack on Iran's oil facilities is being discussed. And a breakthrough in the US dockworkers strike, with the union agreeing to return to work on a tentative wages deal.
Heidi, it was really that focus on geopolitical tensions in the Middle East that sent oil prices surging, right? I mean, we continue to watch Israel really targeting those Hezbollah targets in Lebanon. President Biden, when really asked about striking oil facilities in Iran, he said that topic was in discussion. So we will be watching those oil-related stocks throughout the Asian session today.
Yeah, so much to contend with when it comes to the geopolitical outlook, right? Of course, the other piece of this puzzle is really what we're waiting for when it comes to US jobs numbers. And of course, we had the ADP numbers that were, quite surprising throughout the course of this week, and that really upended some of these Fed expectations for more aggressive next part of this easing cycle. So when it comes to the September jobs report, non-farm payrolls, that's the estimate and that's the prior. But of course, we know that there can be some volatility when it comes to these numbers. Unemployment expected to hold unchanged at 4.2%, and we're seeing not much change when it comes to average hourly earnings there as well. We did hear from the Fed's Goolsbee repeating that rates must fall by a lot over the next year. The Chicago Fed President Austin Goolsbee really reiterating this idea that the narrow focus on inflation has now expanded to the jobs market, saying that he'd like to keep that unemployment rate from rising any further beyond that 4.2% level that we see now.
Yeah, it was really the more solid economic data, especially in the labor market this week, that moved markets throughout, right? Especially as we set up for the non-farm payrolls. We also had the ISM services data overnight coming in stronger than expected and really rising at the fastest pace since February of last year. So where does the Fed go from here is a key question. As skepticism is now rising about how fast they can actually start cutting rates. So we had Treasury yields really spiking. We're seeing the 10-year yield, 30-year yield closing above its 50-day moving average for the first time in more than 2 months. We had also a lot of volatility in the stock space. We saw it marginally lower at the close for the S&P 500 and the Nasdaq 100. But of course, it was really also the moves in the crude space, with oil continuing to soar. Brent was also much higher. So we'll be watching those oil stocks across Asia and trading today. Take a look at how we're setting up, because on the other side of the U.S. dollar trade, which was also higher for 4 consecutive sessions, we had more weakness for the Japanese yen. We're talking about that U-turn that the new prime minister here in Japan has made in terms of where the BOJ should go from here, that Japan isn't ready for another rate hike. That's moved markets significantly. So those yen carry trades in focus throughout the week as well. Take a look at Nikkei futures now, and they're a little bit of pressure at the moment after gains in the previous session. We have, of course, China away on Golden Week holidays, but we are watching the offshore yuan steady at around that 7 per dollar level, Heidi.
And Shery, as we mentioned, we're really watching the next developments when it comes to the Middle East, right? Israel pressing ahead with its campaign against Hezbollah in Lebanon. Meanwhile, President Biden has fueled uncertainty about what could come next as the world braces for Israel's retaliation against Iran.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion.
Bloomberg's Michael Heath joins us now for the latest, and Israel has confirmed more action against Hezbollah targets in Lebanon. That sort of uncertainty that you hear from President Biden really fueling speculation of what we could see next. Is it the targeting of oil facilities? Is it the targeting of nuclear facilities?
Yeah, Heidi, I mean, I don't think it's terrible. It's really news that they're considering the oil thing. It's just unusual for a president of the US to verbalise it, which obviously sent markets, sent the oil price up. I mean, it's got a few options, Israel. It could, as you said, go for the oil facilities or potentially its nuclear targets. But Iran has been preparing for a potential attack on its nuclear targets for a long time. So they're dispersed. A lot of them are underground. It's not a simple task. We know that, I mean, in the 1980s, Israel actually knocked out efforts by Iraq to try to build a nuclear weapon. So I think that would be very difficult. Oil is a potential one, but then you'd suspect that the US would be really wanting them not to do that, because you send oil prices soaring just before the American election. It's not great for trying to win that election. So the alternative is to try and perhaps take down Iran's air defences. There's a lot of pressure in Israel that the strike must be decent. Iran must hurt as a result of this strike, because as we were sort of discussing yesterday, this was a state-to-state attack by Iran. Israel hasn't fired missiles at Iran. I mean, it's dealing with issues in Lebanon now. And as you mentioned there, obviously they're still driving very hard in Lebanon, trying to keep Hezbollah on the back foot after, basically wiping out its leadership.
Could it be a unintended and perhaps, obviously a dangerous consequence of Iran feeling like it's increasingly on the back foot, that maybe it feels now that weaponisation of nuclear is its best defence? Yeah,
I mean, that's a really significant issue, I think. And, I mean, that's not going to affect us in the short term, because it'll take months to do that sort of thing. But look, history tells any rogue state, any state that's outside the international system, that its ultimate best defence is nuclear weapons. I mean, Korea would basically be unified probably if North Korea didn't have nuclear weapons. So that's just fairly clear to anyone who's wanting to protect themselves. I mean, the alternative is you look at Russia and Ukraine. Russia's a nuclear-armed state, a heavily nuclear-armed state, and yet they're still fighting a conventional war. But I think that the hardliners in Iran would no doubt be pressing for that there's nothing to be gained from trying to warm things up with the West. There's no sanctions relief in prospect. And I think they're probably right on that, because who would help Iran now? So, yeah, that will be watched very closely, and I suspect US intelligence is watching it very closely indeed.
And what's the latest when it comes to the incursions into Lebanon right now, and what the US is doing in order to negotiate with Israel on that response?
Shery, yeah, so the G7 put out a statement, and it basically, the US and the other, traditional Western industrialised countries, they put out a statement. They called for an immediate ceasefire in Gaza, and they want restraint in Lebanon. They didn't urge an immediate ceasefire, because obviously that's not going to happen. But they are sort of pressing for some sort of effort, I guess, to mitigate the civilian casualties here. I mean, Lebanon said that nearly 2,000 people have been killed. An estimated 1 million people have been displaced from the southern region. So, I mean, this is a major conflict going on there. There's been Israeli dead. Obviously, there's been quite a few dead on the Hezbollah side. But at the same time, I think there's a general understanding that Israel has Hezbollah on the ropes to some extent. I mean, Hezbollah is not defeated by any way. They've fired 120 projectiles at Israel yesterday, as according to Israel. But nonetheless, for Israel to stop now when it has Hezbollah sort of destabilised, it would be a surprising decision. So I think that'll continue. I think there's a general understanding that will continue, but there's worry about the impact on Lebanon, the civilian casualties. There is aid being provided to Lebanon now, but it certainly needs a lot more. I mean, Lebanon's finances and its state structure were in a terrible state even before this conflict, and this will only exacerbate that.
Bloomberg's Michael Heath there with all of the geopolitical tensions that we're seeing in the Middle East. And amid all this, investors are also looking for further signals on the health of the U.S. economy, with the monthly payrolls report due on Friday. Let's bring in our executive editor for Asian markets, Paul Dobson. And Paul, all of the data points that we got this week, whether it's U.S. job openings, ADP payrolls, we also had, of course, the jobless claims, and now even the ISM services data pointing to more strength than we expected. Are these going to change the calculus for the Fed?
They're certainly going to feed into it, and I think that's why this jobs report is going to be important in terms of determining whether the Fed is going to be likely to continue with 50 basis points worth of cuts at the next meeting, or slow that pace down to 25 basis points. That's really what the market is laser focused on, and it's been pulling back on the bets for another 50 basis point cut slowly through the course of this week, which has seen partly higher short-term interest rates, partly stronger dollar as well. So this could be really important in terms of determining that path. We heard from the likes of Goolsbee, who's on the dovish end of the Fed spectrum, saying, rates need to come down a lot further from where they are at the moment. I don't want to see unemployment. I don't want to see job losses going any higher than they are at the moment. But not all of the Fed is with him. It seems that there's quite a big dispersion of views, and so that's why these data points that we're going to get are going to be really important for them in helping them to decide or get that kind of real feel for exactly, kind of how much of a slowdown we're seeing in the US economy overall, and not all of the data that we've seen this week, like you say, Shery, is really supporting that.
We've also had, of course, the US dockworkers strike, not to mention a great deal of uncertainty when it comes to the outlook for the crude market, right? Could there be sort of uncertainties that would be feeding into the Fed's outlook when it comes to price pressures?
I think that would have to ratchet up quite a lot further in order for the Fed to be focusing on that at this point. The view of the Fed seems to be that inflation is now under control, is vanquished. Yes, one or two would like to see it still lower. But they will probably try to look through things like the crude oil price, unless it gets, kind of long-term elevated. What we had seen in crude up until the latest escalations in the Middle East was actually that it was pretty weak, right? And even after the move overnight, it's only at a 1-month high. So that's not really a huge concern. There are all of those other factors going on in the background, but really it seems like labour market is really where the Fed is focused most strongly at this moment in time.
How much is the Fed taking in everything else that other central banks around the world are doing? We got the latest comments from Governor Andrew Bailey suggesting that the Bank of England could take a more aggressive stance when it comes to cutting rates. Of course, we have the ECB. We have this huge global easing cycle underway. Yeah, I think it's been really interesting this week because all four of the largest central banks, the most important central banks, have seen a little bit of a shift in their policy expectations. I would say the Fed is the sun and the others are planets revolving around the Fed rather than the other way around. So the Fed doesn't really take its cue from them, but they will be heeding quite carefully what the Fed's doing. What we've seen is the BOJ slightly less hawkish in terms of monetary policy, slightly more dovish, people pushing back their expectations for when the BOJ will hike again. On the BOE side, as you were saying, more dovish. Bailey really giving the pound a bump lower, UK yields a bump lower yesterday. And the ECB pretty much nailed on now for an October cut. That's all sort of coalesced recently. And on the US side, moving in the opposite direction, the Fed apparently, maybe just a little bit more hawkish. And so that's why we've seen the dollar really have a very big appreciation this week against all of its major counterparts. So if they continue to pull in that different direction, that could be really interesting for currency traders and have ripple effects across other global markets as well.
Bloomberg Executive Editor for Asia Markets, Paul Dobson there. Well, the union representing US dockworkers has agreed to suspend a strike that had disrupted port operations on the eastern and Gulf coasts. While a wage agreement has been reached, union leaders say talks on outstanding issues such as automation will continue. The union has agreed to extend the master contract with port operators until January 15th, while a new contract is negotiated. Dockworkers will resume work on Friday. Coming up on the Age of Trade, we'll be getting some market analysis with K2 and JPMorgan Asset Management. The Carnegie Endowment joins us later too to talk through the options for de-escalation in the Middle East. And a former BOJ board member shares her outlook for Japanese economic policy under the new Prime Minister. Much more ahead. This is Bloomberg. Take a look at how we're setting up for this final session of the week. A lot for investors to be worried about at the moment, of course, not least of which is watching the developments in the Middle East as we continue to wait for or brace for potential Israeli retaliation there. They have struck Hezbollah targets in Beirut. We're seeing urges of restraint from the US and allies, but continue to watch that given that we're seeing the oil price continue to soar, the dollar also rising on some of that haven demand. Sydney futures at this point looking like we'll see some weakness going into the weekend, as well as Chicago Nikkei futures looking pretty flat at the moment. S&P futures there are largely unchanged, with really that broader focus remaining on what potentially happens to oil prices given this uncertainty over whether Iranian oil facilities might be targeted next. Let's bring in our next guest, who says geopolitical tensions will cause investor angst but will rarely lead to changes when it comes to investment outlooks. With us now is George Boubouras, Managing Director at K2 Asset Management. George, great to have you with us. And, you know, it is true that we've seen this market kind of largely pretty sanguine over the past few weeks and months, when in fact since October 7th last year. Right, we're coming up to that anniversary very quickly next week. But I do wonder whether over the past few days, has that calculus changed somewhat?
Good morning. Good to be here. The reality is with geopolitical, as complex as it is, and it's all about game theory, and we've got the political analysts in there giving their views, it doesn't alter the fundamentals globally very often. And the course of monetary policy synchronisation, stimulus, and the ability for PMI to be expansionary, etc., the fundamentals are still quite solid globally, notwithstanding pockets of pain around the world. But when it comes to geopolitical and trying to price in geopolitical, it's very difficult, again, because it doesn't lead to a significant shock to global economic activity that has got longevity. But it is a big concern, obviously. But when you're taking a step back, I think markets are overtly surprised the neutralisation of Hezbollah after a year-long campaign against Hamas to deal with that issue in that region. And one would think, as all the analysts are saying, that the pressure will be back into Iran with Israel. They've got an opportunity here to make an impact to delay their nuclear program. But taking a step back from that, the GCC economies are still strong. They're still involved in an export sector. They've still got great savings pools that they're investing around the world. So when we're looking at fundamentals, that's why we generally say geopolitical events are short-term shocks. They amplify the headlines. It makes investors a bit concerned. But it's still a broadly buy the dip on risk narrative to oversimplify the comment.
So if you think that the broader narrative is clearly the global sort of synchronised easing cycle, now you've got potentially a bit of reflation from China coming in with their barrage of stimulus, is it perhaps a bit more complicated now that it seems like we're getting really a broad picture of US economic strength?
Yeah, exactly. Again, it is more complicated as we discuss on these programs in 5 minutes. But yes, they've got the synchronisation of the major economies, except for the BOJ and the RBA, they're outliers. But the economic activity in the PMI in the US economy is still quite robust. Earnings are expanding. They're not expanding double digit, but they're expanding. It is a broadly healthy environment to make monetary policy easier on that economy, notwithstanding government has a bigger footprint on GDP in North America over the past 4 years and the previous 4 years of that. And then China, notwithstanding, it needs much more stimulus and more targeted stimulus, and it's been stimulating for 2-3 years. But the broad synchronisation of monetary policy is important. There'll be upgrades to global GDP in the next 3 months, minor ones. But the key here for investors is that we believe discount rates, and many others do believe this, will be higher in the cycle ahead than the previous cycle. It'll be a shallow interest rate cut cycle. It'll just be measured and elongated, again, because economic activity is not contractionary, it's still expansionary. And again, there's weak pockets throughout there, and we'll just focus on the monetary policy. But easier policy, shallow cut, and synchronisation of the themes.
Perhaps too expansionary when it comes to the U.S. economy for the Fed to be able to cut at a faster rate. I just wonder how nervous should we be for the non-farm payrolls and the sharp market reaction, given how much easing has already been priced in?
Yes, spot on. We believe too much easing has been priced in. If tonight's number is overtly weak, a significant outlier weak, it may go into the camp of 50. But the reality is 25 seems to be prudent. Again, because services PMIs are expanding, prices paid components are not behaving themselves. The labour market weakness is there, but it's on the overall scheme of things, labour market is quite strong when you're looking at historical benchmarks and other phases of the cycle and previous cycles. So to be putting more interest rate cuts in the face of expansionary PMIs and a broadly healthy US earnings aggregate market doesn't seem to make too much sense. And that is why everyone's been buying that dip sort of scenario. But we think 25 seems prudent. Market seems to be paring that back. But we do believe the market still has too much interest rate pricing for interest rate cuts, and it just needs to acknowledge that the discount rate will be high in the cycle ahead, and the earnings environment can withstand that over the next 2 to 3 quarters quite easily.
Given what you've said then, how closely should we be watching the Japanese yen as well, given that the BOJ and the new administration seem to be really walking back those hike expectations at the moment? And should we be focusing back again on the yen carry trades that could be attractive?
Yen carry trades back on in the very short term until you get above 150. That's an oversimplification. The BOJ people may be interpreting the language as being a little bit more dovish versus what they've said in March and in September. But the reality is they're not going to be stimulating or going towards that easing camp. They're on that pathway of slow and measured interest rate contractionary monetary policy in Japan. They worked very hard to get here, but the 160 was too weak on the yen. The 140 was extreme. It impacts their earnings outlook, impacts Japanese earnings, hurts the Nikkei. But getting that towards that 147, towards that 150 now, that seems to make the carry trades back on. But the reality is, depending on what the interest rate cycle is for the US, when they start paring back the interest rate cuts in calendar 2025, you'll see the yen strength from that 150 level, low 150s, back towards a mid 145. So hopefully that made a bit of logic there, but it's a bit of a push-pull effect. But every time that yen rallies, it's going to have an impact on expectations on corporate profits for the Japanese economy.
When you take a look at the China stimulus, the associated, elevation off super cheap levels, is this a bit of a false dawn, do you think, or is this a fundamental turnaround in how we should be thinking about Chinese risk assets?
The risk asset rally and surge has been phenomenal from effectively levels, depending on if you look at credit markets from default rates to non-default rates. The reality is the stimulus for the PBOC in Beijing has been ongoing for a number of years, but up until recently, they finally understood you need to actually get some stimulus to the household level. They've been very reluctant to do so until recently. So it's like a mini bazooka. Their export sector is the best in the world. They've got capacity and efficiency to export the energy transition for decades ahead. So they're number one on that. But when it came to consumer sentiment, business sentiment, and the household, they finally understood you've got to pass some relief onto the household. However, this is the construction collapse that they've experienced on the property sector. This is not a 2-3 year fix. This is a 5-7 year plus fix. So they've got a lot of issues to deal with going forward. This is a nice pivot, but much more is required to pass on relief at the household level, which they've been reluctant to do in China. So we'll be playing China through the exporters to China as opposed to mainland China.
We'll be watching the Chinese market opens next week. George Boubouras, Managing Director at K2 Asset Management. Good to have you with us. We have more ahead on the Asia trade. This is Bloomberg. WTI continued to trade higher in the Asian session. This, of course, after gains of about 8% for the week already. Brent has also seen its best week of gains since August. And all this to do with rising geopolitical tensions in the Middle East, really offsetting even resumed oil production from Libya that has returned hundreds of thousands of barrels a day to global markets. President Biden, when asked about Israel striking Iran's oil facilities, just responding that they are actually discussing that. Let's bring in Aaron David Miller, Senior Fellow at the Carnegie Endowment for International Peace. He previously served as a Middle East negotiator for the U.S. State Department. Aaron, great to have you with us. We're continuing to hear about targeted Hezbollah attacks into Lebanon by Israel, but also what sort of comprehensive retaliation could we see, given, of course, Iran's attack on Israel earlier this week?
You know, I think the Israelis basically made a judgment that after two strikes, April 13, 14, and yesterday, the day before yesterday, on directly against Israel, that they have no choice but to respond in order to avoid creating what you could call a new normal. Remember, the Iranian response on both of these attacks came as a consequence of Israel striking an Iranian Revolutionary Guard Corps general in Damascus and then killing Hassan Nasrallah, the head of Hezbollah, in Lebanon. So the Israelis have not struck Iranian territory, only in response to the April 13, 14 attacks. But this time, the Israeli reaction, I think, will be more severe. I suspect it will be limited, at least for this round, to military targets, Iranian Revolutionary Guard Corps command and control facilities, ballistic missile launchers, weapons depots, and the like. When the Iranians respond, as I suspect they will, whenever the Israeli strike occurs, if in fact they open up with a saturation attack, doubling or tripling the number of missiles that they launched day before yesterday, then I think the Israelis will respond again, although this time I suspect the targets will be the nuclear sites, at least the Natanz facility, and maybe oil exporting facilities. Kharg Island, price of oil is going to jump. We could, and I'm not predicting we get there, but we could be moving towards something the Middle East has never seen before, which is a multi-front war involving not the deployment of thousands of ground forces, but a war involving one-way attack drones, ballistic missiles, cruise missiles, AI, cyber, and airstrikes. And I think that's certainly possible. And if that comes to fruition, again, I'm not predicting we're inexorably headed there. It's hard to see the U.S. not becoming involved.
So how do you de-escalate from here?
Frankly, I've been into diplomacy. I was at State Department for almost 28 years. I don't think there's any way right now to stop the first two shoes that are going to drop. Number one, the Israeli strike. And the Iranians will have to make an assessment about how comprehensive severe the Israeli strike was. Is there the possibility that the Iranians would simply not respond? I think that depends on the nature of what the Israelis do. Remember that the primary organizing principle for this regime is not a war with Israel or the United States. It's regime preservation. It's survivability. The last thing the Iranian regime needs, in addition to a terrible economy, deep polarization in the public, and deep rejection on part of large numbers of Iranians to the clerical and military regime of the IRGC. The last thing they need is a major escalation with Israel and the United States. And I think they are counting on the Biden administration restraining the Israelis. I think that is probably not a safe bet right now.
Is Iran being so backed into a corner and feeling so insecure that we're now looking at the possibility that it thinks that maybe weaponizing its nuclear program is the best defense?
It's an interesting question, and I've been asking myself the same thing lately. I mean, they've just seen their crown jewel, Hezbollah, the most lethal, well-armed, non-state actor in the world, hollowed out within 2 weeks. Hundreds of commanders over the last year killed. Veteran foundational members of Hezbollah from the early 80s killed. The Hassan Nasrallah, charismatic leader, and the Israelis killed his predecessor in 1992, Abbas Moussaoui. And it's being reported that the successor to Nasrallah, Hashim Saifuddin, that the Israelis may have tried to kill him in Beirut, disrupting comms, network of intelligence, command and control. So the Iranians have to make a judgment. Are they going to try to rebuild Hezbollah to secure their foothold in Lebanon? Maybe. Will they now, having become a nuclear weapons threshold state, they have within weeks the capacity to produce enough fissile material. They haven't yet produced a physics package, miniaturized the warhead, or found the delivery system. But that could take a year or so. And any traces of weaponization in this environment would most likely mean additional Israeli strikes, and maybe even the commitment on the part of the last 4 presidents of the United States, who said Iran will not be able to produce a nuclear weapon. So yes, they are in a corner. They badly miscalculated with respect to Nasrallah,
Right.
And I think the attack, frankly, surprised me the other day. It was potentially catastrophic, could have caused significant civilian deaths and casualties, even with a terribly sophisticated multi-layer air defense system that the Israelis actually possess. So we are a few steps short on the escalatory ladder of something that could actually move beyond and get out of control.
You know, you've obviously spent many years within this world of diplomacy, you know, in this part of the world. And I do wonder, how do you assess the kind of meaningful influence that Washington has on what Israel does strategically and operationally from here?
I mean, I think you have to look at the last year. And I think you have to realize that the Middle East is littered with the remains of great powers who wrongly believe they can impose their will, their ambitions, their schemes, their dreams, their peace plans, their war plans on smaller ones. When the conflict becomes existential or near existential, as it's been for Hamas, Yahya Sinwar, and Benjamin Netanyahu, and now for Israel and Hezbollah, and perhaps now for Israel and Iran, the impact of external powers in an existential conflict to fundamentally dissuade, restrain, change, alter fundamentally the trajectory of the courses that these leaders are on, I think, frankly, is very, very limited. It's their neighborhood. They're prepared to invest far more than the United States has ever been prepared to invest. And you look at Iraq and Afghanistan, the two longest wars in American history, despite the asymmetry of power which favored the United States. The standard for victory in these two wars proved to be never could we win, but when could we leave, and what would we leave behind? So I have very little confidence. No fault of the Biden administration. You've got one of the most consequential elections in American history within a month. And the last thing the Biden administration needs, frankly, is a major conflagration in the Middle East. But at the same time, that election constrains the degree to which this president is prepared to use the influence he has on Israel. That's the paradox that the administration finds itself in. They need to prevent a major conflagration, but they can't use the influence they have with the Israelis, because the act of restraining the Israelis in these circumstances would allow conservative Democrats and the Republican Party, which has emerged as the Israel Can Do No Wrong Party, to basically pick up points, and it would display weakness in their eyes with respect to supporting Israel. So I think it really is a bind. You need to hope somehow, and I wouldn't bank on this, that both Israel and certainly Iran is risk averse to understand exactly the difficult situation that they are in, and whether or not they're prepared to absorb an Israeli hit, which could come, in my judgment, any time from Saturday night, get through the Jewish holiday of Rosh Hashanah, which is today, anytime from Saturday into Sunday morning and in the next week or so. I think that's the frame within which the Israelis will probably respond. And, you know, I suppose the good news, if there is any good news, is that there is a degree of extraordinary coordination between the Netanyahu government and the Biden administration at this point. There was no coordination with the walkie-talkies and the pagers. There was no coordination with the hit on Nasrallah. There was certainly no coordination, because the Israelis haven't claimed responsibility for it, for the assassination of Ismail Haniyeh on July 31st in Tehran. But there is coordination here. And I think it reflects the fact that the Israelis understand hitting Nasrallah in Lebanon is one thing. Striking core infrastructure targets, military facilities in Iran, pushes this conflict to a new level. And I'm hoping that Washington and Jerusalem will have worked out something that will deliver the message, the severe consequences that Jake Sullivan has talked about, but at the same time, not created a point of departure, or as I mentioned before, for something the Middle East has never experienced, which is a multi-front war.
Aaron David Miller, thank you for ending on some semblance of a hopeful note there, Senior Fellow at the Carnegie Endowment for International Peace. Let's take a look at how all of this is playing out when it comes to a great deal of uncertainty for global investors, right? This is the Friday session futures picture that we're seeing. A lot to the downside. Sydney futures looking like we'll see really on the back foot as we get into the start of trading in about 15 minutes or so. Chicago Nikkei futures also looking a little bit soft at the moment. We could really see a lot more action when it comes to trading on the FX side as well, with this soaring in haven demand for the dollar, as well as getting into non-farm payroll as well. We did see that big move in the euro as well as the pound overnight. EU member states, in the meantime, are preparing to vote on Friday and imposing definitive tariffs as high as 45% on imported EVs made in China. Let's bring our China correspondent Min Min Lo for more. So, Min Min, do we get a sense of how the vote is going to proceed?
Yeah, it's really hard to call that right now. It could be quite split. We know that European officials were quite confident that they have enough votes to push through the tariffs, but then they were also a little bit cautious about making a prediction after the Spanish Prime Minister Pedro Sanchez had broke ranks with the EU after a visit to Beijing. Germany as well is another key player that had abstained in the previous vote. German officials have signaled they could abstain again. Reuters is reporting they may even oppose the vote this time. That's after we have heard from the CEOs of Mercedes, Volkswagen. They were all lobbying the government to really vote against the tariffs for fear of retaliation from Beijing, because these German car makers, they make about a third of their sales in China. They sell millions of cars to China every year, and Beijing, for one, had hinted that they could retaliate with tariffs on vehicles with large engines. This vote is taking place later today, but we know ahead of this vote, the Chinese Commerce Minister Wang Wentao had been on this whirlwind tour to Europe to try to convince European partners to vote against it. They had discussions around putting price controls and volume controls on cars exported to Europe. Not clear now whether there is any breakthrough on that front, but we'll see. We know the two sides will continue with those talks even after the vote takes place today.
With all of the economic risks that Beijing is facing, of course, we have seen the barrage of stimulus measures. Could we even see more fiscal measures in place?
Yeah, there has been a lot of anticipation that more fiscal measures could come in after that Politburo meeting that signaled the government will spend as necessary. And now we have leading economists, one from a former head of a research institute that is linked to the Ministry of Finance, calling on the government to issue up to 4 trillion or even 10 trillion yuan in special sovereign bonds. He said that if these bonds come with long maturities of 30 to 50 years, that offers great flexibility. It wouldn't overburden the government. And this comes as more and more economists are expecting that there could be some sort of fiscal package. What is unclear now is the scale of it and the contents of it. And it comes as there has also been warning that stock market mania could actually be a bust, especially if fiscal measures don't follow through to really fix some of the fundamental issues in the economy.
Bloomberg's China correspondent Min Min Lo there. And of course, as we head towards the market opens here across Asia, we'll be watching the EV space. Nikkei now reporting that Toyota and Subaru will work together to market an EV in Japan, the US, and Europe for 2026. Production will begin around January of that year at a Subaru plant. Capacity will rise to as much as 20,000 vehicles per month. We have more ahead on the Asia trade. This is Bloomberg. From rate hikes on Asia and NATO, Japan's new prime minister has been backpedaling on some major policy pronouncements just days into the job. Bloomberg Opinion columnist Haidi says that's left investors, analysts and diplomats scrambling to pin down Shigeru Ishiba's plans. Haidi joins us now, and more than backpedaling, this seems to be like a big U-turn here. So is this just positioning and strategizing ahead of the general elections? What should we make of this?
Certainly that's part of it. I think, it was already hard, I think, to pin down exactly what it was Ishiba stood for, even before the vote for the LDP leadership happened just a week ago, if you recall. But on top of that, some of the things that he had outlined that seemed to be clear parts of his policy, he is already, stepping back on. I think, as you say, this reflects the fact that, well, he's bringing up the election. That's going to happen in just a couple of weeks. And then B, the fact that his support within the LDP is not as stable as he might hope. So someone who maybe had a better well of support from the lawmakers within the LDP might not need to do this, but you're seeing already, with his comments on the BOJ, on rate hikes, that because he doesn't have a stable base within the party, they only chose him because they, lawmakers did not like the alternative, which was Sanae Takaichi. He is having to make comments like he did on the BOJ just 2 days ago that really go beyond what we would expect, I think, a leader in his position to be doing at this point in his term.
How much capital does he have with the public? Because we know he came into this with, a fairly high level of approval and popularity.
It's a very good question, because certainly the reason that he is in the position that he's in is because he polls very well with the public, and he consistently has polled very well with the public. He is, believed to be publicly popular. And I say believed because the question is he popular, or is he representative of an idea that's popular? Is he just, the alternative, the proxy for anti-Shinzo Abe thought within the party, which he has represented for, over a decade now. The polling that has come out since he became leader is okay. It's better than Kishida was doing, but it is quite low. You have the Mainichi poll up there, the Nikkei poll that came out earlier than that said that he had the lowest polling numbers for a new prime minister since polling began. In that case, that the polling extends only back to 2002. But I think he would have hoped for a better bump than he has gotten from that. So there's just a couple of weeks until the election, so that's going to really, we're going to find out, I think, how popular he really is.
Right. Haidi, Bloomberg Opinion columnist there with, of course, the latest on the new Prime Minister, Shigeru Ishiba. Let's actually get a preview of the market open given the latest comments from the new administration with our senior Asia stock reporter, Hideyuki Sano. We'll get more clarity from Ishiba's policies with the policy speech that we're expecting from him later in the afternoon. In the meantime, investors are already reacting in terms of the Japanese yen.
Yeah, very much so. And I think it's interesting to see some sort of parallel between what happened when Kishida came in and what's happening now. If you look back when Kishida became Prime Minister, there was a lot of skepticism about what he's going to do, because he was talking about hiking capital gain tax, and that didn't really go down well in the financial markets and also within the business community. But it took only just a week for him to take that back, and he switched his course to basically focus on rather than sort of taxing the rich, trying to help build wealth for Japanese households. So he tried to put pressure on companies to hike wages, and also he began this expanding NISA program, and that really, investors really liked that. So some market players are cautiously optimistic that Ishiba might follow in his footsteps.
Especially given that we've been calling this sometimes the Ishiba shock, as it was a Kishida shock, but a lot of the calls that were strong before he actually became elected, banks could do better with Ishiba, for example. How are we expecting some of those calls to play out, and what are the sectors that we should be watching out for?
That's still hard to say because, I mean, in general, Ishiba has said he will basically continue Kishida's policy, but I think Debbie is always in details. And in terms of, I mean, regional banks are obviously one big focus because Ishiba has been talking about how to revitalize local economies. But on the other hand, on many other issues, if you look at how he flip-flopped on the BOJ policy, I mean, a lot of market players got the impression that he probably doesn't really haven't figured out exactly what he wants to do. And everyone knows he's a defense nerd, but he hasn't really been involved with economic policy. So, I mean, we need a bit more to see what's going to happen.
Hideyuki Sano, our senior Asia stock reporter. We'll have more on the Asia trade. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens as we look ahead to the U.S. non-farm payrolls numbers after more indications of a solid labor market. Data points this week, Haidi, pointing to strength. We had services sector data also leading to the upside, but of course it's geopolitics, what we're watching as well.
All of this complicating this outlook when it comes to Fed expectations and how aggressive this easing cycle could potentially be, right? But as you say, Shery, as we see that haven demand for things like the dollar, it could be quite an interesting session when it comes to Asian FX this Friday.
Yeah, especially with the dollar, as you said, gaining for a fourth consecutive session. We had Treasury yields higher, really being propelled by that ISM services sector numbers that came in higher than expected, rising at the fastest pace since February of last year. That strength really helping propel the U.S. dollar. And on the other side of the trade, we had more weakness for the Japanese yen, right now holding steady at that 147 level. While the Nikkei and the topics coming online, really subdued at the moment, but futures pointing to the upside. Of course, we have Shigeru Ishiba, the new Prime Minister of Japan's policy speech later in the afternoon. We'll be watching that for more indications of where Japanese policy making goes from here. But take a look at how the Kospi is coming online. Korea coming back from a holiday. We had the Kospi really pressured throughout the week. The Korean won seeing a little bit of strength against the U.S. dollar at the moment, Heidi.
Take a look at how we're setting up. Of course, it is that staggered session here in Sydney. And of course, we're heading into a long weekend there as well. So perhaps a little bit of sort of volumes to the downside if there are already some people that have gone away for that long weekend. But take a look at the ASX at the moment. We are setting up for a little bit of downside if the future session proves to be correct. We're off by about 0.25% at the moment. This is a market that has been trading pretty close to those record highs. And a lot of that has been really driven by the big gains in the miners on the back of the China stimulus news, so they continue to be in focus this Friday session as well. We're also looking forward, of course, to the RBNZ meeting in the week ahead. So again, more hints as to where this next part of the cutting cycle takes us. The Aussie dollar is holding pretty steady. 68.51 is where we're trading. And of course, as Shery mentioned, really watching treasuries as we had some of the commentary out from Austin Goolsbee from Chicago saying that rates again must fall by a lot over the next year, but also saying that he's comfortable with where that unemployment rate of 4.2% or thereabouts is at the moment. So a lot hinging on the non-farm payrolls number, really kind of the last puzzle piece after what has been a week of data that has pointed to perhaps surprising resilience in the US economy. Also a lot going on when it comes to some of these energy names. So we'll be watching the oil producers, the likes of Santos, for example, as that come online as we watch the situation in the Middle East. Let's get more now from Tai Hui, who's the APAC Chief Market Strategist at JPMorgan Asset Management. And I'm going to start off with, these sort of developments when it comes to geopolitics. We've seen a lot of investors typically shrugging off these concerns. Do you see much sort of carry through for Asia when it comes to a potential change in the outlook and the narrative for oil?
Obviously, the energy prices is going to be the key factor here. I mean, we've had a lot of tension in the Middle East for the past 1 year, but up until this point, the markets, as you rightly said, have been shrugging off most of the impact. But as Iran become more involved in this confrontation, I think the market fear is that there could be supply disruptions coming out of Iran, or even around the Strait of Hormuz, where a significant part of the global energy supply goes through. So from that perspective, I think that's part of the reasons why we've seen energy price react to the way that we've seen in the past couple of sessions. But at the same time, we do have stimulus coming up from China. We are growing expectation that the U.S. economy can achieve a soft landing. So all that put together, I think it does imply that, at least on the demand side, the demand for energy oil should remain relatively healthy. At the same time, the risk on the supply side is still very much there, even though OPEC and non-OPEC members, they do have plenty of spare capacity to support any potential disruptions. I think that's going to be the key factor here.
How much conviction do you have behind the China rally?
Well, I think a couple of things. First of all, the change in the direction and the mindset from the authorities, that to me is really important. But at the same time, I think we're all watching out for a couple of data points coming up. First of all, how have consumers reacted during this National Day Golden Week holiday? Are they feeling more optimistic? Are they feeling the wealth effect at the moment? Number two, in the next weeks and the next couple of months, how is the government going to follow up with more fiscal support to the economy? Ultimately, a lot of these measures that we've seen announced in the past 2 weeks, we've seen those before in isolation. Frankly, they have not been super effective, but in combination alongside with the help of more fiscal policy, which obviously deliver a much more immediate impact on the economy, that could potentially change the game. But as I said, we have to wait for those policies to come, and that could come in the fourth quarter. And that, to me, will be the key factor in sustaining the rally that we've seen so far.
It's such a different story from what we're seeing in the U.S. with continued signs of strength, especially in the labor market, even the services sector now, right? How closely are you watching the non-farm payrolls to come on Friday for any jolt in the markets?
The job numbers, inflation numbers are absolutely critical because at the end of the day, if you look at what the Fed's doing right now, they are very much reading the data and then deciding what they should do in the next meeting, which is going to be on the 6th and 7th of November. And therefore, if we do get a relatively strong non-farm payroll data tonight, what it could mean is that it's going to be a 25 basis point cut in November. But if we get further weakness in the job markets, you could hear the market whispering again whether the Fed could move 50. So, I think the fact that the Fed started with a 50 basis point cut, it does open to a broader range of possibilities when it comes to the next move as well as for December. But right now, we're still looking for 25. I think the non-farm payroll tonight should be supporting that.
Given where the U.S. is going right now and where the Bank of Japan is going right now, what are the expectations for where the Japanese yen goes from here? And could we see more upside given now the renewed weakness of the Japanese currency? I think this is the worst week in 8 years against the greenback.
I think the broader direction of the Japanese yen as well as major currencies should still be on an appreciation path for a couple of reasons. First of all, the U.S. economy is indeed very strong. That I think the gap between the U.S. and the rest of the world in terms of economic growth is gradually converging. And that, to me, should put some pressure on the U.S. dollar, downward pressure on the U.S. dollar. At the same time, despite the 5-6% correction in the dollar index since June, the U.S. dollar is still relatively expensive. So the fact that the Fed is engaging monetary easing, U.S. growth is converging with the rest of the world, that to me implies for a softer dollar going forward. And that will imply not just against the Japanese yen, but against other major currencies, Asian currencies, that should be a bit more downside for the U.S. dollar.
Is there still a sense of wait and see to see if we have sort of true portfolio rebalancing in favour of China and away from markets like Japan?
I think so. I think we've seen a lot of more short-term flows coming into China at the moment, both retail as well as hedge funds. I think for a lot of the long-only investors around the world, they do want to see that data point. They do want to see those policies coming through, as well as the second round, third round of policy support to the Chinese economy. And of course, we've got the US elections coming up in a month's time. So I think from that perspective, there's a lot of questions over US-China relations going forward. How will that change with the next administration? So I think from that perspective, it will take a little bit more time, a little bit more data for international investors, especially in the US and Europe, to re-engage with the Chinese markets. But that said, speaking to a lot of emerging market investors in Latin America, Middle East, and also Southeast Asia, I think what they want to see more is the macro data turning around. On the geopolitical side, I think they do feel a bit more comfortable with investing in China at this point.
Hi, Hui, good to have you with us. APAC Chief Market Strategist at JPMorgan Asset Management. Of course, we are previewing the non-farm payrolls in the U.S., but also just watching all of the movements across Asia markets right now. Take a look at Korea zinc surging at the moment, up above that 760,000 level. And this is really above the MBK's tender offer price. We know that Korea zinc is now fending off a tender offer by private equity firm MBK Partners as well as Yongpeng to control the company. We have seen Korea Zinc teaming up with Bain Capital to buy back up to 18% of outstanding shares. Right now we're seeing the stock gaining in the Korean session. Of course, Korea has just come back from holidays. Take a look at how 7&I is also trading as well, because 7&I was seeking to sell off part of a stake in its banking unit. According to sources speaking to Bloomberg, we're seeing gains of more than 2%. They're facing, of course, that takeover approach from Couche-Tard, and we have heard that they're exploring the sale of part of its stake in 7bank. We have more ahead on the Asia trade. This is Bloomberg.
Support Israel striking Iran's oil facilities, sir?
Where'd the structure up?
President Biden there speaking to reporters outside the White House, and Bloomberg's Michael Heath joining us for those latest developments on the escalating conflict in the Middle East. And of course, it was crucial about that sort of simple comment from President Biden is talking about it's still under discussions as to whether Israel, is forming part of its reprisal against Iran would be targeting oil and gas facilities.
Yeah, I mean, clearly the oil infrastructure was part of the discussion. I mean, everyone sort of understood that, but saying it out loud, I guess, was sort of unexpected. I mean, it's sort of an interesting question whether the US would really support that, because obviously that's, as we saw the response in the markets, that would probably drive prices up. It's not a great thing just ahead of a US election. But the difficulty here is Prime Minister Netanyahu and Israel is under a lot of pressure to make this reprisal significant. I mean, this attack by Iran, Israel hadn't attacked Iran, sending 200 ballistic missiles. Quite a few got through past Israel's, very, very, very good air defences. And while there wasn't, there wasn't huge damage or anything like that, they did hit various bases and that sort of thing from the reports we've seen. So the question is how you calibrate that, how you make Iran pay without escalating the whole thing, and it's a very, very difficult thing to do. I mean, one discussion is whether they try and take out their air defences to show that they can make them defenceless there. Or, the extreme one, as people have talked about, is whether they try and hit Iran's nuclear infrastructure as well. So while that seems highly unlikely because it's very dispersed across the country, all options seem to be on the table.
And Iran, through its proxies, have suffered, some extraordinary losses over the past few days. That doesn't look like it's going to let up. And I suppose the question is, at what point do they feel like nuclear is going to be their best defence? Yeah,
well, just to your first point, I mean, it was interesting. Overnight, Israel's conducted more strikes in Beirut, and it looks like they were, from the reports anyway, looks like they were targeting the expected successor to Nasrallah. There was as many as 11 bomb strikes basically on that, huge shockwaves that came out of it. So we'll just have to wait and see whether what came out of that. But yes, the question of Iran turning to nuclear, while it's not going to really impact things immediately, it is a really pressing one, because the more that those proxies are pushed back, they'd provided Iran with a sort of their conventional ability to threaten Israel or wage the war without it affecting Iran. But as they're degraded, as they're pushed back, the question becomes about Iran's security itself. And history's shown over the last 50 years that if you have a nuclear weapon, you can be pretty confident that no one's going to be attempting regime change or anything like that. And just to say, Israel's believed to be nuclear armed as well.
How challenging is the situation for the US and the rest of the G7?
Yeah, it's very challenging, Shery, because obviously they, when we're looking at Gaza, when we're looking at Lebanon, the US clearly doesn't have much influence over Prime Minister Netanyahu, and in a sense that's understandable, because Israel has a much better handle on what it can do there, what the options are, has such outstanding intelligence, that sort of thing. But also, I think that the Israeli leadership sort of realises that because there's an election campaign going on in the US, it has a bit of a window to act a bit more independently. Now, when we're talking about internationally, I think, country to country and Iran, I think perhaps the US will be more influential. It certainly was last time Iran fired at Israel. It managed to restrain Israel and temper the response, and Iran didn't retaliate again after that. But this time around, as I said, the demand in Israel is for something more significant. Now, Europe and the US they're talking about putting more sanctions on Iran over these attacks and over the missile firing of the missiles. But the question is just, where we sort of go from here, because while they'd like a ceasefire in Gaza and while they'd like things to calm down in Lebanon, really Israel is not going to stop now while it's got Hezbollah on the ropes.
Thanks, Michael Heath there, and take a look at the impact on oil that's really being played out. And of course, oil shares are in focus as well, as we see crude extending that surge. And in fact, Brent crude climbing on course for its longest run of daily gains since about August. We have, when it comes to WTI, surging towards that sort of $74, $75 a barrel level there, after, of course, President Biden said that we're discussing that in response to a question about whether he would support Israel attacking Iran's crude facilities. We are seeing predictable upside here when it comes to some of the Aussie players. Woodside Energy, Santos there, Woodside putting on more than 2% at this point. We're also watching Impex in Japan. Impex, the outperformer there, as we really see this player in particular. This is, of course, Japan's largest upstream energy company. They're particularly sensitive when it comes to movement in oil prices. Crude is about 74% of sales. We're also potentially seeing that impact of the yen as well when it comes to a boost to local currency earnings. Shery.
Heidi, at least we could see perhaps a sigh of relief when it comes to the supply infrastructure in the U.S. Dock workers at U.S. East and Gulf Coast ports have agreed to start moving cargo again while they continue bargaining with employers on a new contract. Bloomberg managing editor Kate Davidson has been following the latest developments and joins us now. Kate, how consequential is this? Because this is a suspension of the strikes that could resume in January.
Right. There are definitely some important issues that still need to be worked out, but it is consequential for just the near term. Right now, it means that cargo will start being unloaded again. The dock workers, there's about 47,000 of them on the Gulf, who work at Gulf and East Coast ports, who've been off the job since midnight on Monday. So this just 3 days of backlog could take almost a couple of weeks to clear. So that the fact that is getting moving again, I think everyone is very, it's welcome news. We saw the White House issue a statement, the National Retail Federation. So certainly everyone's excited, but there is a note of caution because they have to work with issues like concerns about automation that the union is concerned about. They want protections there. So none of that is set in stone. They'll have to continue these discussions between now and January 15th.
What do you see as potentially the real sticking points that we should be looking out for?
Well, as I mentioned, the automation issue is really the big one. It sounds as though there has been some agreement around wages, which was another sticking point. We have seen some reports and seen union officials saying that there is basically an agreement in a new contract to have wage increases close to 62% for the dock workers. That's much closer to what they had been asking for. We saw that there was a sort of a last-minute offer from the shipping lines, the employers on Monday for a 50% increase, and that didn't do the trick, but the White House has really been putting pressure on both sides this week to come to a deal. So it seems that there was agreement around the wages, but then that just means that the bigger, thornier question around automation, which we've seen that some advancements there on West Coast ports in the U.S. and certainly around the world, some of those advancements haven't come to the East Coast and Gulf ports yet, and that's in part because of resistance from the union. And so they will have to work out, language in the agreement that's acceptable to them.
So how important are these ports in the global supply chain, and how long will it take to clear up some of the backlogs that we might have seen this week given the strikes?
Sure. Well, we had been seeing some analyst estimates saying that for every day that the workers were on strike, it would take approximately a week to clear the backlog. Some more recent estimates have suggested it could be a little faster than that. We've seen, about roughly 12 days it would likely take. But still, that means for cargo, some of which, it's auto parts, it's equipment, it's medical supplies, but there's also a lot of fresh fruit. I mean, we know one of the ports in Wilmington, Delaware, is responsible for bringing in about 2/3 of the country's bananas. So that's just sitting there right now. We have been seeing the number of ships anchored off of these ports just rising each day. I think it went from about 19 on Monday to 43 today. So there's certainly a lot for them to unpack and unload. We know that the union has said that work will begin immediately, possibly as soon as tomorrow morning. It's not clear whether they'll be working through the weekend, but it is going to take some time. And all of these ports collectively are responsible for about 50% of the world's shipping.
Bloomberg's Kate Davison there with the latest on those dock worker strikes across the U.S. We have more ahead on the Asia trade. This is Bloomberg.
Bank of England Governor Andrew Bailey has suggested that the central bank could take a more aggressive approach to lowering interest rates. In an interview with The Guardian, Bailey said he was encouraged by the fact that the cost of living pressures were not as persistent as the BOE feared they might be. The pound posted its biggest one-day slide against the euro since late 2022 after those comments. We'll take a look at how we're setting up, given those big moves across FX was really the focus of the previous session. But take a look at the setup for futures as we go into that Friday session. Oil will remain front and centre. We'll see some pretty significant moves when it comes to oil majors in the Asian session, and that should play through as that one of the parts of the narrative as we get into the start of trading in Europe as well. We have seen that slide across European stocks, despite, of course, some of the bump given by luxury and retail stocks in the wake of the China stimulus enthusiasm. Euro Stoxx 50 futures looking pretty flat. German DAX futures also looking pretty weak at this point. We've seen sort of underperformance across European equities in the red, almost in a wholesale way, including some of the steeper declines across automakers, miners and construction stocks there. Well, in the meantime, EU member states are preparing to vote on Friday on imposing tariffs as high as 45% on imported EVs that are made in China. Let's bring our China correspondent Min Min Lo for more. Also, do we have an indication of how this vote is going to proceed and what the implications are if it is a yes?
Yeah, it's a bit hard to say right now. We know that Germany, for one, is likely to either abstain or oppose the vote. They had abstained in the previous vote. The Spanish Prime Minister Pedro Sanchez had expressed his opposition to the vote, but to the tariffs. But when it comes to the actual vote, it's really hard to say now whether China has enough member countries that would oppose those tariffs, because they need a qualified majority of 15 member states that make up at least 65% of the EU population to vote against the tariffs in order to avert it. Now, the implications here, if the vote is a yes, that means those tariffs will kick in on November 1st. And by some estimates, it could cause a drop in Chinese exports by as much as 25%. And of course, given that the tariffs are applied unevenly across different companies, some companies like BYD, for instance, that faces a lower tariff will have a competitive advantage compared to its other Chinese rivals. But there's also concern that maybe it could also lead to an escalatory trade war between the two regions if China chooses to, react retaliatively.
Given the economic risks, are we expecting more in terms of stimulus measures for China?
Yeah, there's been a lot of calls for more measures from China. The big question here is how big of a package it would be and what are the contents of the package. Reuters previously reported that China could issue another 2 trillion yuan in special sovereign bonds, half of it to tackle local government debt and half of it to try to lift consumption. And this comes amid growing warnings from some economists that stock market mania could turn into a bust if the fiscal policies don't follow through to fix some of the fundamental issues of the economy. And you have Rajiv Jain, for example, one of the top managers for an emerging market equity fund, saying that if the party goes on in the Chinese equity market, it's okay that they don't join it, because there are some people who still think that this could be a very fleeting rally in the Chinese markets. And the jury is still very mixed, because some, like Morgan Stanley, still believe there's another 10 to 15% upside to Chinese equities if the fiscal policies come through.
Bloomberg's China correspondent Min Lo there. We have more ahead on the Asia trade. This is Bloomberg.
My administration will steadily continue and further develop this policy of making Japan an asset-building nation. In addition, one of the major pillars of our economic policy will be creating an investment nation that attracts investments from both within and outside the country, including flows of money toward Japan's regional economies.
Prime Minister Shigeru Ishiba addressing the Asset Management Forum Japan here in Tokyo. Take a look at how assets are trading at the moment. We're seeing the Nikkei gaining ground, being led higher by energy and utilities. Financials are also gaining ground, although tech stocks are under pressure. Of course, we've been watching JGB yields very closely, given the expectations or BOJ policy trajectory. The Japanese yen strengthening a little bit, but after significant weakness against the U.S. dollar. Of course, we continue to watch where the new prime minister's economic policies will go from here. And right now, we're seeing this focus back on carry trades. Take a look at these pairs right now. Remember when we had the big unwind of the Mexican peso yen carry trade, the Brazilian real yen carry trade. We know that Japan's $4.4 trillion of assets offshore could potentially be impacted in terms of capital flows back home if the BOJ does not tighten as fast as markets had been expecting. Our next guest says she expects economic policy continuity from Japan's new administration. Joining us now is Takako Masai, chairperson at SBI Financial and Economic Research Institute. She previously served as a board member at the Bank of Japan. Great to have you here in the Tokyo studio.
Good morning.
So we are expecting that continuity from the Kishida administration. What do we know then in terms of BOJ policy? Because Shigeru Ishiba seems to be walking back a little bit of the commentary that he's had on BOJ policy.
Actually, the important thing is whether the BOJ policy decision-making is going to be changed or not. And when you look at the real economy right now, this week, the Tankan survey from the Bank of Japan had released. And then when you're looking at the data, the corporate activity is fine, and the corporate profit is okay, and also the monetary policy is still accommodative, and also the important thing, the direction for the prices by the decision-making, the big decision-making in the corporates are still upside. So if we are if I were the student member, if we're looking at this number, it's really good. So it's really natural to see, to consider to the rate hike for the Bank of Japan.
Do you expect that positive sentiment to actually keep translating to positive wage growth here in Japan? Because the deflation mentality has been set for decades, right?
Yes.
So even if we see real wages now finally in positive territory, we're just talking about a few data points when 30 years went by with stagnation.
That's exactly the Ishida mentioned about it. And then interesting thing is that the Bank of Japan used to keep mentioning on that aspect, but it's really fading right now. So to me, it's a good balance between the government and the Bank of Japan, because Bank of Japan seems to be a relatively hawkish comment out nowadays, and then on the contrary, on the government side, I think it's natural to be seeing the government side saying, hey, please calm down and a little bit cautious on the decision making, because, as you said, Japan has not experienced with the interest rates, with the economic cycle. So it's a good balance, and then we could see some of the reaction on exchange rates, which is a range bound. If the Bank of Japan, as much as this hawkish, together with the stance following the government, what would happen to the exchange rate, right?
That reflation mindset is really interesting to me because, as an external sort of person going into Japan, so much is said about the appeal for tourism, for example, because of the levels of the yen. But it's not just the yen, right? It is just the fact that prices haven't moved for so long. Do you think a more confident or aggressive approach from the Bank of Japan and communications from the government would help when it comes to building those, animal spirits or corporate confidence or small business confidence in being able to raise prices?
As far as if we are looking at it as far as the short term, short term would be to continue to see the Japanese economy to relatively keep the growth. So in that sense, yes, the Bank of Japan will keep seeking the best timing to hike the rates. So that is the kind of the flip-flop contrast between the Fed policy and the Bank of Japan policy. So it will continue. That's my idea.
Do you think there is a sweet spot or a Goldilocks spot when it comes to where sort of ideal levels for the yen would be? Yeah,
where is the Goldilocks spot or not, or sweet spot? But at least I could say in the range bound, I think between 140 to 150 would be the comfortable area, together with this contrast or direction of the policy between two countries.
Well, what's interesting is that some economists think that overall, a weak Japanese yen is good for the economy, right? Exporters. And then it's say, because you have the big companies and the trickle-down effect of all of these benefits. But then I hear the other side of just civilians here, the general public. And they think, well, yeah, the Japanese yen is not going as far. And how much is there really trickle down when a lot of the dominant players, the big players, don't necessarily pass on those benefits to the smaller supply chain, middle-sized companies, given the power structure in Japan? Is that a concern?
Every statement you made is right, but when we're talking about weaker yen is good for the Japanese economy, means exactly the mean is good for the Nikkei, right? And when you're looking at the consumer side, of course, Japan is most of the items are imported nowadays, so it's cheaper. The stronger yen is better for the consumer activity. But net, still, a relatively weaker yen. I'm not saying that extremely weaker yen is good. It's obviously bad, but the relatively weaker yen and also the lower volatility is better for the economy. That's for sure.
Are we expecting a relatively weaker yen, at least going forward from here? Because it was really interesting that the new cabinet ministers and the Bank of Japan reaffirmed that 2013 joint statement on beating deflation. And it seems they want to keep that 2% inflation target as well.
As far as I see that the new Prime Minister confirmed that the accord that the government and the Bank of Japan made back in 2013. So yes, that is included, I think.
So that means we're going to keep on.
But actually, 2% has been hit for 2 years, right?
Right, for more than 2 years already for core CPI, right? But what does that mean then in terms of how investors should be watching where BOJ policy goes from here? Because they keep saying we're still seeing easy financial conditions, but we're still tightening.
Actually, the still weakening of the Japanese real interest rate is relatively extremely accommodative. That for sure. That's why, I think for the Bank of Japan standing point is they are not saying that we are tightening, rather than they are trying to do the normalizing for the interest rates.
When the Fed started QT and just reining in the balance sheet, we saw those shocks and volatility over there. Do you feel that BOJ policymakers are taking that in?
That's a great point, because I'd like to mention that, emphasize that point, because BOJ's communication nowadays is a little bit straightforward, and also they are seems to be so eager to hike the rates. But they never mention about the markets, because at the same time they are saying they are reducing their balance sheet at the moment. And as you mentioned, that the concern or in the market should remember that what happened to the Fed was shrinking their balance sheet. So that's something missing to me from the Bank of Japan communication, that what they are looking at or care about that kind of risks having the Japanese government bond market. That's I agree.
Takako Masai, good to have you with us here in the Tokyo studio. She's chairperson at SBI Financial and Economic Research Institute. We'll have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're tracking when it comes to this Friday session here in Asia. We're seeing a little bit of sort of mild upside when it comes to trading in Japan. At the moment, the Nikkei 225 up by just about 0.2%. We continue to watch for the trajectory of the yen, particularly with that haven demand, the gains that continue to play out when it comes to the dollar, and then, of course, going into the non-farm payrolls data later on in the day as well. Watching oil and energy names in particular, we're seeing some big gains for the likes of Impex in Japan, as well as Santos and Woodside here in Australia. Some of the outperformers, but broader downside here for trading in Sydney ahead of a long weekend. Energy continues to the main theme as oil continues to soar on these Middle East tensions ahead of, again, as I mentioned, more US data, as we've seen kind of a picture of resilience being painted over the course of this week for the US economy. We are less than an hour away from the start of trading this Friday session in Hong Kong as well, and this historic rally in Chinese stocks taking a breather on Thursday. The Hang Seng China Enterprises Index finishing the last session down 1.6%, snapping a 13-session run of gains, though optimism running high that the current rally is different from previous rebounds that have been ultimately short-lived. For more on what we're expecting today, we're joined by Catherine Nye, who leads our Asia stocks coverage. And Catherine, this is, if only we knew the answer to this, but this is the question on every investor, every, strategist's lips, is whether this is a false dawn or whether this is a real deal this time.
Absolutely. And, if I can make a small joke, I mean, this is becoming sort of a battle of the opinions, right? A battle of overnight, we saw, HSBC upgrade Chinese equities. Morgan Stanley talk about how, they think that there's 10 to 15% upside here. And then on the other side, we have, Nomura talking about some risks, that this is too much like 2015, that we have, JPMorgan warning about some risks of the upside. I mean, this is such a push and pull right now. And makes sense given just how dramatic this rally has been. I mean, I think a lot of people are anxious. They want to get in. They're seeing, all of this upside potential, but they're worried, and that makes a lot of sense given just how volatile this market has been.
So what sectors have been rallying so far, and what could we see when mainland markets come back from Golden Week next week?
Right. So, I mean, it's really important to note that because the mainland market has been shut, the Stock Connect, which is the links between, the Shanghai and the Shenzhen exchange, and Hong Kong has been shut. And traditionally, a lot of, the mainland buyers and investors have bought into the Hong Kong market via some of the biggest tech stocks. So, I mean, that is an area definitely to watch next week. Given just the big rally in the Hang Seng Tech Index, we're probably going to see that continue. Over this past week, some of the standouts, property, right, particularly some of these, defaulted developers that are up, 100, 200%, 400% or so. That I think people are quite concerned about because they, the rhetoric or the growing chorus there is that this has gone much far beyond fundamentals, but it's also a really cheap, attractive play. Brokerages has been another area that has been under-owned and has seen just a really strong move up, and so these kind of three areas are I think kind of top of mind. And of course, given the Golden Week holiday, and with some of the numbers coming out, the demand for travel looks resilient, is what Citigroup is calling it. Looks steady, looks slightly better than it was last year. Slightly better than what people were projecting, not gangbusters, but some of the consumer stocks, some of the travel stocks. I mean, that will definitely be on traders' radar.
Yeah, we saw that record number of rail trips being made on the first day, right, which is certainly encouraging. I do wonder, though, when it comes to the outlook for the sort of consumer-facing stocks, the overall confidence boost, does that really rely on perhaps more fiscal measures coming through from the government?
Absolutely. I mean, this is the sort of the one hesitancy, the to be sure in everyone's argument, right? That, everything looks good, this policy blitz, the market is responding, everything is finally kind of falling into place. But the way that the economy is and whether this can be sustained is the big one. And I think that there's, coming out of this Golden Week holiday, there's a little bit of hesitancy. Like you were saying, there's some strong numbers, but looking at a bigger picture, it doesn't look as, the numbers don't necessarily reinforce the way the market has been trading. And I think this is going to be, if there is a reckoning, it's going to be in whether, the buying patterns and the consumption is really going to match up to it and the way the economy continues on. So a lot of, investors, a lot of analysts are calling for further measures, for easing, further measures to ensure that this rally isn't just, a quick fade. It's going to be long lasting.
Bloomberg's Catherine Nye there with what we can expect out of the Chinese markets as we continue to watch the currency space right now. Muted moves across Asian currencies. We are now seeing the Korean won actually reversing some of those earlier losses against the U.S. dollar. This really coming on the back of perhaps a little bit of a rebound in the treasuries market in the Asian session. Remember, we actually saw a hit overnight with yields gaining for a second session. This to do with stronger than expected ISM services numbers, not to mention that the U.S. jobless claims numbers were also subdued. So really rising slightly but consistent with a limited number of layoffs, and will be setting up, of course, for the non-farm payrolls. Former New York Fed president and Bloomberg Opinion columnist Bill Dudley says he's been too pessimistic about the risks of a so-called hard landing for the U.S. economy. He spoke to our colleagues Jonathan Farrow and Lisa Abramowitz.
My original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a half a percentage point, trigger the SOM rule. Check. But the SOM rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question, and that's why the Fed cut 50 basis points, a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. It's still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Fed Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing at all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Former Federal Reserve Bank of New York President Bill Dudley there speaking with our colleague Lisa Abramowitz. Take a look at what we're watching when it comes to the energy sector in particular. This is going to be this one outperformer that continues to see upside given these escalating tensions in the Middle East and how we're continuing to sort of watch for further upside in oil prices. We have really seen energy futures continuing to jump there, the dollar also gaining. A lot of this hinging on what President Joe Biden said in terms of we're discussing that in response to a question about whether the US would support attacks on Iranian oil facilities. We saw Brent on course, in fact, for that longest run of daily gains since August, and gains when it comes to WTI there as well. We are seeing the Topics Oil and Coal Production Index up by over 3%. Some good gains when it comes to INPEX, in particular, the biggest upstream player there in Japan, particularly sensitive to moves in crude prices and particularly sensitive when it comes to the impact on earnings from weakness in the yen that we're seeing as well. Here in Australia, some of those big players also seeing some incremental gains, the likes of Woodside as well as Santos. Not so much of an outperformance, though, when it comes to oil and gas players there in the Korean market. Take a look at broader commodities, because what we've also been watching has been how long this iron ore rally has to play out, right, given that some of the enthusiasm on the equity side over the China stimulus bets have really kind of ebbed a little bit, or at least taken a bit of a breather. We're seeing copper, for example, giving back some of those gains there, as we've seen a number of days now that we've had since to process those stimulus measures in China, of course, away for the Golden Week holiday. Copper at the moment, a little bit of upside there. Iron ore retreating just about 1% when it comes to trading in Singapore contracts, and Brent crude still up just under $78 a barrel. You can watch us live and see our past interviews on our interactive TV function. That's at TV Go. You can get more details on those securities or Bloomberg functions and join in on the conversation as well. You can send us instant messages during the shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.